Taking a look at the markets, today's Money Metals Minute brought to you by MoneyMetals.com. Markets were quiet again yesterday as investors were awaiting today's Fed Reserve meeting announcement. U.S. stock finished nearly unchanged. Two major European banks under pressure in the face of negative interest rate policy announced they're preparing to impose negative rates on their depositors. Negative rates may stimulate demand for precious metals. Historically, gold and silver was at a disadvantage to holding savings in cash as banks paid actual interest on cash deposits, but now they enjoy a relative advantage. 0% is higher than a negative yield. Now here's a special report from Mike Gleason at Money Metals Exchange.
It is my privilege now to be joined by Dr. Chris Martenson of peakprosperity.com and author of the book Prosper, How to Prepare for the Future and Create a World Worth Inheriting. Chris is a commentator on a range of important topics such as global economics, financial markets, governmental policy, precious metals, and the importance of preparedness, among other things. I'll get right to it here. For starters, what did you make of the Brexit decision last month? Is this potentially the beginning of some meaningful opposition to the ongoing drive for a world government, or was this just a one-off event?
No, this was not a one-off event. This is a continuation of a pattern that we've been talking about at Peak Prosperity for a while. We thought there were three scenarios for the future. One of them we called fragmentation. I think this is the beginning of it. And fragmentation has its roots in a growing wealth gap. It happens when you have a stagnant to shrinking economic pie that is increasingly seized by the elites who are tone deaf. And when they do that, people get cranky, and this is the first form of crankiness we've seen break out. Austria's next. We're going to see this sweep across Europe, I believe. People have seen that austerity is just a punishment by the bankers upon the average people for the sins of the bankers. It feels unfair, because it is. So I think Brexit as a political statement is just the beginning. And of course, the powers that be are going to do everything they can to paint this as a mistake and punish the wrong people again.
What about the banking system? Despite some recovery in the past week or two, the European bank stocks have been getting hit hard. We're seeing that Italian banks need a bailout, and share price of Deutsche Bank is signaling that the firm is in real trouble. The IMF just named them the riskiest financial institution in the world. There is a rally here in share prices. Brexit appears largely forgotten, and Wall Street certainly isn't acting too worried. Is the concern over European banks overdone, or might we see a firm like Deutsche Bank actually collapse? And what do you see as ramifications here in the U.S.?
The European banks are absolutely in trouble. I think they're insolvent. That's the step that precedes bankruptcy, which is a legal action. Insolvency is just when your assets and your liabilities have a big mismatch. We know that that's the case for the European banking shares. It also explains, Mike, why we're seeing this rally. We call it on Wall Street, but it's global. We saw two things. First, we saw a big decline, a scary decline in January, and then this miracle nipple bottom, vault back up to the highs that came out of nowhere. To me, that was a liquefication event. Somebody put a lot of liquidity into the system. We know the central banks are coordinating on this because they're scared of the Franken-markets they've created. They can't even tolerate a few percent decline without freaking out. That should freak ordinary people out, because if they're scared, you should be too. So they re-liquefied like crazy, and then we had just another post-Brexit re-liquefication. My evidence: stocks at all-time highs, bonds at all-time highs. Listen, you can't have that unless there's a lot of liquidity coming from somewhere. People can't be panicking both into negative interest yielding bonds and stocks at the same time for this to make sense through any other lens than the central banks are absolutely pouring money into these markets.
I want to get your thoughts on the Fed. We've had mixed economic data, growth below expectations, and central bankers everywhere else are ramping up stimulus. Janet Yellen and company are finding it exceedingly difficult to tighten. Throw into that this is an election year. What do you see the FOMC doing between now and the election?
Yeah, that's the 85% probability. I'm on record as saying that I thought it was more likely that they were going to lower rates instead of raise rates on their next move whenever that comes. I said that back in December after that first tiny little wiggle hike. And the reason I said that is because, look, you can't have the United States raising rates while the rest of the world's rates are going down. That just doesn't make sense from a variety of logical standpoints. But let's be clear, the Fed follows. It doesn't lead. This is not an aggressive, assertive organization that ever since Paul Volcker left. These are not people who have the moxie to run against what the markets want. They're totally captive to the markets. The markets are clearly saying rates are going down. I don't think this Fed has it in them to do anything other than follow the markets. So since the markets are going down, the best the Fed can do is hold pat. But at some point, honestly, I would put a little more money on the wager that said the next surprise will be to the downside, not the upside, especially in an election year.
That was Chris Martenson of Peak Prosperity and Mike Gleason at moneymetals.com. Live prices at moneymetals.com show gold currently trading at $1,321.25 and silver at $19.65.